The ARK Innovation ETF, ticker symbol ARKK, has absolutely smashed the S&P 500 over the last 5 years. What is happening, investors? It is your boy Jack. I am not a financial advisor and I got a cheeky little shave, people. I look about 5 years younger, man. What is going on? Anyway, for the first time ever, we're going to be having a look at an ETF on the channel. And as I said, the ETF we're going to be looking at is the ARK Innovation ETF. Now, if you're not familiar with ARK or who they are, okay, essentially the portfolio manager is Cathie Wood. And she is the woman who put a $7,000 price target on Tesla by the year 2024. ARK manages more ETFs than just this particular one, but this is pretty much their biggest one and most spoken about one. What we're going to do today is we're going to have a look at the 10 biggest holdings in this particular ETF and see why has this portfolio done so well compared to the broader market and if it's potentially a good investment. It's a very new school style of investing, you know. It's not your traditional value investing or anything of the likes. It is new school. It is about innovation, which is why I think particularly a lot of younger investors are getting involved with these guys, because a lot of us want to be in the next big thing before it's, you know, the next big thing. So right before we get into having a good look into this ETF, can I please ask you to drop a like on this video? It would mean so much to me. If this video gets over 400 likes, which you guys get more often than not, I will speak about ARKW in a future video. If you're new around here, please hit that juicy red button, join the family. The road to 20,000 subs is on. And lastly, drop me a comment down below. Let me know what you either think of any of the individual companies that we speak about today or the ETF as a whole. With that being said, guys, let's get straight into our first company of today, which happens to be none other than Tesla. And before we even get into Tesla, here is what the ARK Innovation ETF's mission is. Essentially, they're focused on ARK's belief that innovation is the key to growth. The ARK Innovation ETF is built on the cornerstone investments that present the best risk-reward opportunities from ARK's innovation-based themes. Essentially, they're looking for the next big thing. A lot of these will be growth stocks. They're looking for disruptive innovation. In the last year, this ETF has gone up 67.31%. The S&P 500 has gone up 7.4%. In the last 5 years, they've returned 269%. The S&P 500 has returned 51.72%. So they have a very, very good history. Now, their top 10 holdings, and this is as of the 15th of July. We're recording this video on the 16th, so this is very up to date. And first up is Tesla, which takes up 10.61% of this ETF. And ARK is known for their Tesla valuations and their price targets of $7,000+, so it's no surprise that they are in here. I am a brand new Tesla investor. I bought at literally $1,700. I only got half a share. I plan on buying more potentially today, maybe next week. I'm buying a few companies today. I'll tell you what they are on the weekend. But I mean, Tesla literally is the definition of disruptive innovation. Just look at that 1 year chart. 512%. That is mental growth. You don't see that anywhere else. Also, there are some positives coming very soon, such as an inclusion in the S&P 500 and their battery day, which more than likely will only propel their price up further. And in the short term, I think Tesla is a company that absolutely anything could happen to. I mean, the stock price could go up or down 10% on pretty much any given day for next to no reason. But in the long term, I think Tesla is, even at these prices, a fantastic investment. That's why I did go ahead and get involved. But you all know who Tesla are. I'll probably make a video on them on the weekend. We don't need to get into them. Let's look at some of these other companies that you might not be familiar with. Next up, we have their second biggest holding, okay, Invitae Corp. So simply put, these guys are in genetic testing. So you can go to this company and you can order, you know, a test. You could get a diagnostic test, which will give you information to understand or diagnose an inherited disease or uncover the cause of unexplained symptoms. So if there's something wrong with you and you're not quite sure what it is, you could get one of these tests and it may well tell you about it. Or else if you know there was a history of a particular disease or illness in your family, you could get one of these tests to see if you are susceptible to it or if you do have it or if you're a carrier. You could get a proactive test, so just to be safe, you know, you could learn if you're more likely to develop certain conditions so that you can take steps to stay healthy now and in the future. And reproductive tests. Helpful information to guide important health decisions before, during and after pregnancy. Now, they were founded in 2010, okay? They have been public since the 13th of February 2015, so relatively new to being a public company. And we can see this massive spike up very recently. So in the last 6 months, you know, they were down like everybody was. Then they made this nice move to the upside, up 69.84%. On the yearly chart, it's actually a little bit worse because they were downtrending, still up 50% for the year. And the 5-year chart, they're up a total of 175%. So they saw 64% growth over the same period last year in regards to the amount of specimens received by its laboratories. But then the volume of diagnostic tests submitted to Invitae fell by as much as 50% in the last 2 weeks of March alone because of the virus. On June 22nd, the company announced it would acquire cancer diagnostics company ARKK for 325 million cash and 30 million shares of stock, plus an additional 27 million shares based on performance milestones. So this is obviously massive for the company, for what they do. So ARKK has two unique products that could become game changers, okay, personal cancer monitoring and StrafeDX. So combined, these companies are expected to generate $316 million in annual revenue with a 43% gross margin, 50 to 60% yearly revenue growth, and a net loss of $130 million in 2020. And they do only have a market cap of $4.3 billion right now, so still a relatively small market cap, only public for about 5 years, could be a good opportunity. And judging by the fact that they are the second biggest holding in the ARKK ETF, that speaks for itself. Okay, next up we're speaking about Square, a company that absolutely everybody is going to know and be familiar with. So what Square is mainly known for is these point of sale systems here. If you're in the US, you probably see them in an awful lot of stores. They're just very efficient for businesses. Now Square has been on a pretty incredible run of 75% the last 6 months, and from the bottom that actually equates to over 220%, which does mean they're currently trading at a PE ratio of 264, which is very high. Now that's not to say that it can't keep going up, of course it can. And a lot of analysts as of right now have them at a hold or buy rating with an average analyst price target of $92. In the short term, analysts expect it generally to go down, but in the mid to long term they do expect it to go up. So that just is kind of, quite a clear sign that a lot of hype has gone into these guys and they could be somewhat overvalued, but in the medium to long term, it probably is still relatively safe. Again, it is disruptive technology. It's an absolutely fantastic service. All of you guys know who these are, so I won't go too into it. I'm not invested in them just yet, but I genuinely have considered. But that's Square, and they are 7.64% of the ETF's weight as of right now. Next up, we have a company called Crispr Therapeutics AG, ticker symbol CRSP. And these are another company in genetics, gene-based medicines. And what they do is really interesting. This one here in particular I thought was crazy, okay? Editing cells inside the body to treat genetically defined diseases. So imagine you have some sort of genetic disease, and literally this company can just edit the genes that you already have to completely eradicate it. Again, this is the definition of disruptive innovation. I mean, this is something that you think about when you think of the future. You think about, being able to make everybody essentially perfect, have nobody have any defects, nothing of the likes. Some people might think it's like playing God, but I mean, it's going to happen at some stage, and if this is the company to do it, it's going to be crazy. Creating the next generation of cell therapies for cancer enabled by gene editing and broadening the applications of stem cells through gene editing. So they want to change genes. Another company relatively new to being public, okay? 21st of October 2016, they went IPO at $13.82 a share, and since then they've gone up over 575%. In the last year, up 92.41%. The last 6 months, 56.5%. ARK clearly believes in these gene-related companies. I mean, this is their fourth biggest holding in this portfolio as well. And I must say, it's not something that I ever really looked into until I started looking into these ARK ETFs. But I mean, it's crazy. I mean, they're trying to make gene editing technology that they can harness to modify, delete, or correct precise regions of our DNA. I mean, that is insane. Short, mid-term and long-term outlooks are up by analysts all around, despite the fact that we're at a PE ratio of 123. But I mean, it's a relatively new company. Oftentimes relatively new growth companies do have high PE ratios. They're at a price of $93.32 with only a market cap of $6.38 billion. Now, analyst price targets average are at $77.27. So I mean, even at the price we're at right now, that doesn't represent a big loss if you were to invest. And as of right now, in July, people are saying to hold, buy, or strong buy. But again, it's just a very exciting company overall. Okay, fifth up, one that a lot of you will probably be familiar with, Roku. Roku on the 6-month chart, okay, up 17.6%. On the 1-year chart, up 37%, and on the 5-year chart, up a massive nearly 500%. So Roku is a streaming platform, and I think that's why it doesn't excite me so much, because there just is an awful lot of streaming platforms out there. Roku devices give you access to 4,000 plus free and paid channels, so you can stream almost anything, and that includes, your TV channels, catch-up TV, music, okay, Vivo, Deezer, and blockbuster movies, original content, and the latest TV shows on channels like Netflix, Amazon Video, Now TV. So this is like almost the daddy of streaming sites. So analysts are saying performance outlook short, mid and long term up, but there's not very analysts saying that you should buy as of right now. I mean, we have a sell, we have a hold, we have a very small amount of buys. But again, the average price target from where it is right now is only down just over 15% from where it is, so it's not the biggest risk. For me personally though, it doesn't really excite me. I will personally stay away from this one, but the fact that they have them in the ETF wouldn't stop me from directly investing in the ETF. Okay, TWOU. So TWOU is an American educational technology company that contracts with non-profit colleges and universities to offer online degree programs. We power world-class online higher education, going beyond traditional learning management systems. We use tech, people and data to help top universities transform in the digital era and eliminate the back row in higher ed. So I mean, I think this is pretty cool. I actually think this is a fantastic service to have out there right now. And as of right now, they've had over 229,000 all-time enrolled students across all products. There was 133,000 plus short courses, 60,000 plus degrees, and 36,000 boot camps. Now, to me, this one hits a bit of a sore spot because this is a company I was looking at the crash. Literally, I remember looking at these guys. I heard about these guys a while ago, a couple of years ago. It must have been when they were a relatively new company. And I had my eye on them. And I remember seeing this and they were around the $15 mark. And I heavily considered investing, but I was just too afraid. And back then, my investing goals were a little bit different as well. I was more interested in dividend stocks. I wasn't as, willing to take risks. The analyst recommendations, as of right now, all 9 are either on a buy or a strong buy. The average price tag is at 36, so a little bit lower in the short term. But then they obviously expect it to go up in the longer term. And there's kind of constantly news coming out in regards to these guys doing better. So the Ohio State University College of Engineering launches first coding bootcamp in partnership with TWOU. Amherst College partners with TWOU. Columbia and Penn to offer summer high school coding bootcamps in partnership with TWOU. I think there is a massive place in the future for a company like this. Illumina, another one a lot of you guys will be familiar with. So another biotech related company, researching cancer, microbiology, agrigenomics, cellular and molecular biology, complex disease, and then clinical, genetic health, oncology, and reproductive health. Now, this is a company who hasn't actually grown as fast as a lot of the other companies in today's video, okay? 6-month chart, 17.29%. 1 year chart, we're up 26.47%, and the 5 year chart, as of right now, they're only up 59.46%. So it doesn't really seem to have grown as much as the other companies. And despite that fact, they are trading at a PE ratio of 60.3. Another company with a short-term downwards performance outlook and a mid to long-term up. And analysts have a lot of mixed opinions here, but generally there are more buyers than holders and not a lot of sellers at all. Average price tag right now, $343. So I won't get too into them. I could probably make a full video on these guys if you do want it, but I don't really like them as much in this ETF. I mean, it's the innovation ETF. They're a very big company. They haven't had near as much growth as a lot of the other companies that they're in. I don't know. If I was going for growth and if I was willing to take some risk, I'd much rather Invitae or Crispr. Okay, we have 3 more companies to look at. We have a little company called Photo Labs Inc., ticker symbol PRLB. Again, a quick look at the stock chart. Okay, 6-month chart, we're up 7%. 1 year chart, we're up 7%. And a 5 year chart, 67%. So a market cap of only $3 billion with a PE ratio of 50.35. So these guys are a digital manufacturing partner. So they're in injection molding, CNC machining, and 3D printing. So right now, it's a company that can move very easily off of some news, okay? So they gained 24.4% in May. They rallied amid momentum for the broader market, excitement surrounding a potential breakthrough in the 3D printing industry, and investment in a new production facility. So again, it's one of these companies who is small enough, a market cap of 3 billion, where a little bit of news can really move the stock's price. I mean, you see that there, that jump was massive, but since then it has just been coming back down really and steadying out, and now we're just kind of waiting for the next piece of news. Now look, these guys don't excite me too much. I'll be honest, I've not really looked into them too much either though, whatsoever. Maybe I will look into them a bit more one day in the future. Okay, second last, Lendingtree. Lendingtree is the largest online lending marketplace in the United States. It connects borrowers with multiple lenders so they can find the best deals on loans, credit cards, deposit accounts, insurance, and more. $315 a share, market cap 4.12 billion, PE ratio of 139. 6-month chart up 1.6%. 1 year chart we're down 25%. On the 5 year chart up 282%. So it's been a pretty wild ride for Lendingtree. Short, mid, and long term is up by analysts. Revenue climbing at a very nice rate. Earnings not so much. Average price target is considerably lower than where it's at now, and analysts are rating this somewhere between a strong buy and buy in general. So I mean, this is a really cool service, and I could understand why it would do well right now in the world we live in. A lot of people are going to struggle financially and are going to put more time into finding what's the best way to save money. And I gotta say, where I'm from in Ireland, there isn't really anything set up like this that is as clean and straightforward and simple as this website is. I mean, if I want to get a personal loan for whatever reason, I can just click into personal loans. I want to do some home improvement, think, you know, I want 15k. That's what I want, 15k. I would put in all of the relevant information and they would save me a whole lot of searching around and just give me the best option possible. And it's another company who, as the world goes online, as e-commerce becomes more and more popular, as people don't want to waste as much time looking for these things, they should do quite well. So I can understand why they're in there. You know, I'd feel somewhat comfortable putting some money into them. At the same time, not too excited. Okay, and the final company, Zillow Group Inc. An American online real estate database company founded in 2006. 6-month chart, a weird one, but ultimately they're up 25%. From the bottom, up 136%. 1 year chart, fairly similar to be honest, up 20%. And if we go to the 5-year chart, it looks like a massive dip, but it was a stock split. It was a 3,207 for 1,000 split. So for each 1,000 shares you own pre-split, you now own 3,207. So if we just take it from here, it's actually gone up about 122% in 5 years. All in all, not bad. Another company with great short, medium and long-term outlooks according to Yahoo Finance. Negative earnings, which is obviously not something you like to see. And as of right now, analysts are pretty much saying hold one with a strong buy. And the average price is about 20% down from where it's at right now. And it's easy to understand why. As of right now, there's not as many people buying or selling their real estate. So that's why short term, I could see this being a little bit shaky. But who knows what could happen in the long term. Again, I like to see industries moving online, and this is a company that's trying to make that happen. So these guys connect buyers, sellers and renters with the people and services they need to make it easier to get into the home they love. But I have to say, as of right now, the world we're living in right now, I don't really like the look of them, especially not compared to pretty much all of the other companies that we had a look at today. But that's the 10th company. I think this is a fantastic ETF. I more than likely would actually invest in them, except it's not available on my trading platform on Trading 212. But I do really just love the concept of this ETF, the disruptive innovation. Ultimately, I believe if you want to get involved in some of what could, you know, be the biggest companies around in the next few years, maybe the next 5-10 years, but you don't want to put in all of the research looking into all of these brand new companies, ARK is a great place to start. Cathie Woods has shown time and time again she's an absolutely incredible investor and fund manager. I would actually invest in this ETF if I could, and I probably will buy some of the companies in this ETF in very small amounts. If you watched till the end, you are a true legend. I appreciate you so much. You are helping this channel out so much, people. It means a lot to me. Please do drop the video a like if you haven't yet. Subscribe if you're new around here. Drop me a comment down below. I hope you have an absolutely fantastic day. I will see you tomorrow for 2 brand new videos. Peace.